Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm located in Naperville, Illinois. This show does run in multiple markets, so if you can hear the voice and the show, then we can certainly work with you. So our job is to craft portfolios that can do well whether the markets are up, down, or sideways. Most individual investors are always going to make money when the markets are up. They're going to lose money when the markets are down. And then in a sideways market, it's anybody's guess. The job of an advisor is to bring strategies to the individual that can actually make money when the markets are down. That is key. Make money when the markets are down. Tax strategies. If you're working with a big bank or a big brokerage firm, unfortunately, you're just not going to get proactive tax strategies that can greatly reduce your taxable income to the tune of $70,000 to $80,000 per $100,000 invested. Those are the strategies that we're talking about, that we are doing in our financial planning process, our program. And generally, we're working with clients that have a few $100,000 to several $1 million of investable assets that they're looking for comprehensive financial plan, but most importantly, strategies that can also do well when the markets are down. So give Paige a call, 630-492-1912, 630-492-1912. Set some time up for your initial conversation with myself and my team, and we will see if we can ultimately help you out and share with you what we are doing. So for those that listen religiously, thank you. We see the podcast numbers. They're going up and to the right. We like that. We are doing investment dinners throughout the Chicago market, started in January, and we are really following Morton's Restaurant. So if you're near a Morton's Restaurant, we have very targeted dinners for you. These strategies are for investors who have a minimum net worth of $1 million, not including your primary residence. And the profile of this investment is tax reduction along with distributions. It is in the energy space. So if you want to be able to reduce your taxable income by $70,000 to $80,000 per $100,000 invested, invest in the backbone of America in the energy space and have an investment with targeted distributions in the neighborhood of 13 to 18% annually. That's not affected or not dependent upon the stock and bond market, then this may be a good 10%, 15%, 20% allocation of an overall portfolio. Our next dinners are in Naperville coming up on March 13th and 14th. So $1 million net worth exclusive, not including your residence, and want strategies that can greatly reduce your taxable income. So if you sold a business, sold a building, are a high wage earner, then this is something that you're probably going to want to learn more about. The dinner is March 13th and 14th. Just give Paige a call. So you and I can have a short call. We don't want to waste your time, so we'll go over exactly what it is, what it's not. Our energy team is coming in from Texas, and they're there at the dinners. So high market overview, go over strategies that can make money when the markets are down, and then go over the alternative strategy with in the energy space with the tax benefits. That's generally how the dinners work. So again, very educational, very, very happy that, I made the decision. Well, hopefully I'm happy. I did make the decision to get the message out through dinners this year. Investors need it. They just need it. I'm so tired of, the same old boring strategies for individuals, and then individuals wonder why they're just tracking the market up and down, and that's just not good enough. Everybody has made money over the last handful of years. I mean, really since 08, you should have just have killed the market. That doesn't mean that your strategy is a good strategy. That doesn't mean that the advisor you're working with is adding value. That doesn't mean that. I mean, the question that I always ask individuals is, look at what happened in 2022. Did you lose money? Equities probably did. Okay, fine. Pass there. Fixed income. Did you lose money? I mean, most individuals lost 10 to 30% in fixed income, their quote unquote safe money. You just have to have an open mind. And that's what we're on a mission to do. We're on a mission to allow individuals to retire fearlessly. You may laugh at it. It may sound corny as can be, but that's the reality of what we're trying to do. When we see headlines that it's been 30 years since food has eaten up the percentages that it is of your income. Food spending is, as a share of disposable income, it's the highest it's been in 3 decades. I mean, seriously. We always talk about inflation. We always talk about, what inflation does. But do we really bring it home to the individual investor? That investor that has, say $500,000 to $10 million. And, we really look at, what are you being brought to invest in? What are you being brought that's different? And, we're just on a mission to let investors know that the markets can go up, they can go down, and they can go sideways. And the chances are is that you have nothing in your portfolio today that can actually make you money if the markets are down. And it's not, some small investment. I mean, these strategies are readily available from the largest banks in the world. We did a JP Morgan dual directional bank note in the last handful of weeks, and the cap on the upside was 20%. So you knew you were going to get, let's just say for to keep it simple, it was tracking the S&P. So you knew that your maximum gain was 20% in 15 months. So they looked at the S&P today. In 15 months, they'll look at the S&P again. You got the first 20% of the return. So 0 to 20, you received 100% of that return. If the S&P did 21%, well, you only got 20%. All right. So again, this is for our quote unquote safe money. The benefit to that cap on the upside was you actually made money on the downside. So most of the absolute return buffers that we're going to utilize are 20%. All that means is if the S&P 500 is down from 0 to negative 20, your return on that 15-month investment is the inverse return. So if the S&P is down 20, your return is positive 20. If it's down 10, your return is positive 10. If it's down 5, your return is positive 5. If the S&P drops more than 20% over 15 months, look at 20% as your zero, negative 20% as your zero. So if the S&P is down 21, you're down 1, 22, you're down 2, etc. Think about that. Why in the world hasn't your advisor brought you that? Because that's a strategy that can actually make money if the markets are down. And here's the beauty. These strategies, first off, most advisors couldn't tell you what a dual directional banknote is to save their life because they didn't start using them 15, 20 years ago. And they may act like they know what it is, but they really don't know what it is. They may not have access to that. And, those are the things that an advisory practice needs to bring to a client. On the income side, how about this? How about a strategy that we just did last Friday? Again, a JP Morgan note. So all of these bank notes, you're buying the bank of the credit or the credit of the bank. How's that? The bank of the credit. You're buying the credit of the bank because it is a bond. I mean, it's a bond not like you know of, but it is a bond. So you have to have a good bank. So whether it's JP Morgan, Bank of America, Citigroup, BMO, I mean, we're only using the best of the best, right? The beautiful thing about these predetermined strategies is we can create for 30 to 40% of your portfolio, probably better rates of return, having a cap on the upside with the ability to make money on the downside than what you're currently doing. Most people today, all they are doing is riding the market up and down. You never talk to your advisor. The advisor adds no value. It just is. If the market's up, you're happy. If the market's down, it becomes sit and wait. Well, here's the question. Ask your advisor, do you invest exactly how the clients that you advise? Do you have those buy and hold strategies? Do you have those strategies that leave so much to chance? Or is your personal money a little bit more proactively managed? Do you have more defined outcome strategies in your portfolio? And I would venture to guess, like, it's a simple guess, but just knowing the industry, knowing other advisors, and just, having, the intellectual capital that I have benefited and really learned over the last 27 years, is I bet 9 out of 10 advisors don't invest their personal money, their family money, the way that they invest your money. And that's just not good enough. So back to the income note. So we were able to do a JP Morgan bank note on the income side, 3 years, not callable for 6 months. So you were going to own it for 6 months, but then the bank could call it at any time after that. Sometimes they do, sometimes they don't, but it was a three-year actually, this was a 23-month investment. It was a JP Morgan note. So you're buying the bank credit, followed a couple indexes. Again, for simplicity's sake, let's just say it tracked the S&P. This one tracked 2 other indexes as well, but just so I don't confuse you, it tracked the S&P. You made 11.2% as long as the indexes did not drop 30%. So all they do is look at it from issue. They lock in the indexes. And every single month, while you own that, they go back to the date it was issued and they look at the indexes. Is it down more than 30? If it's not, you're paid your coupon. Think about that. In theory, the markets could be down 30% and you could still make 11.2%. Most people will take that. Most people who lost money in fixed income, I have to wonder, why are you still working with that advisor? Why did that was we saw that train coming, not just us, everybody did. We saw that train coming for years. The Fed was saying, we're raising rates, we're raising rates, we're raising rates. I've seen people that have lost 30% of their safe money. And these investors are just shell-shocked. And that's, a fear of mine. It's an issue. I'm concerned about it. It's just not good enough. So let's have a call. Let's learn about how we're using strategies that can do well, whether the markets are up, down, or sideways. Give Paige a call. It's a simple conversation with me. 630-492-1912, 630-492-1912. As I come across on the radio, I am that way in person. My job is to educate. My job is to simply educate you on what is out there that your advisor's not telling you. If you own mutual funds and you have over $100,000, why? Why do you own mutual funds if you have over $100,000? The fees, you don't see the fees, mutual fund fees, advisor fees, you're probably paying 2 to 3%, and you're over diversified. That's something that Wall Street doesn't talk about. Over diversification. Studies have been shown if you own more than 12 stocks, the diversification does not help you. But yet that's all advisors preach. So, there's a lot of risk out there. Household debt hit a record, and I just read this study this week, 17.5 trillion. Even as the Fed is worrying about mass defaults could potentially happen, the New York Fed is saying that, listen, mass defaults could potentially happen. Household debt is just continuously going through the roof. I mean, that's on top of the 34 trillion in federal debt housing that still has to be paid. So together, $51 trillion in household debt. That is just a lot. When you look at household debt and credit card debt and other debt that makes up a household, there's just a potential for a day of reckoning. And that's not me trying to be an alarmist. That's not me trying to scare investors, because candidly, I don't care. I would absolutely welcome a large pullback. Truth be told, in this industry, when the markets are chaotic, when people are losing money, people listen to a story that they may not listen to when everybody's making money. So if I'm looking at it selfishly, if the markets drop, that's great. That's just more opportunities that I could share our story with individual investors on how to add to portfolios, buckets of your money that can actually make money when the markets are down. And that's the job of an advisor, staying in the game. Let's talk about a very well we're going to talk about our Growth Plus allocation after the break. We don't often talk about it, but we're going to talk about that and why I think there is a lot of opportunity to make money. So 630-492-1912, 630-492-1912. Give Paige a call. Let's set a time up for us to have a conversation or a meeting. We are in Naperville off 59 and 88. Some people know it as the Calamos building or the Citygate restaurant building, but 59 and 88 were very easy to get to. So 630-492-1912.
Puzzled by your retirement options? It can be hard to put together a retirement strategy without being able to see the whole picture. Kuhn Capital Partners takes pride in providing comprehensive retirement strategy services to our clients. Our comprehensive services integrate all aspects of our client's financial picture in a coordinated effort to provide for financial clarity and multi-generational wealth. Visit kuhncp.com or give us a call at 630-492-1912 to schedule a consultation today.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. Thank you for joining us today. Hopefully you are listening to this driving around on a Saturday. If you're catching it on the podcast, thank you. My only ask for you is if somebody needs to hear the story, if somebody needs to hear a different way of looking at the world, if somebody wants to incorporate strategies inside of their portfolio that can actually make money when the markets are down, please just forward on the link. Hopefully they can listen to the show, and if it's right for them, they will reach out to us to set up their initial conversation. So 630-492-1912, 630-492-1912. We are a financial-based planning firm. I think everybody should have a financial plan. You probably would not get on an airplane without somebody. If a pilot, well, I don't even know if, goodness, there's so much craziness going on with airplanes lately, and we work with a lot of commercial airline pilots. So if you're a pilot at American or United or Southwest, we understand, we know our competition in that space, and I think you will be very pleased if you do reach out to us because we can certainly talk about your 401k and the other money that you have outside of your retirement plan. 630-492-1912. But you wouldn't get on a plane without somebody, or if the pilot didn't have, unless they had a filed flight document, a flight plan. I mean, it's all about checks and balances, especially in the airline space. There's backups to backups to backups. There's redundancies. There's, every single pilot, all of our clients, they could be, flying a 777 overseas, have, a rank in, what am I thinking? Senior leadership or whatever. I can't remember that name right now, but they may rank, in tenure, 2 or 3 or 4 or 5, but yet they're going over a checklist on even the most basic remedial of tasks. And there's a reason why. You want to have a high level of predictability on exactly what you're doing. And when it comes to investing, it can't be understated that in this market today, yes, there's a lot of risk. There is a tremendous amount of risk in the market. The top 10% of stocks now reflect 75% of the entire market. I want to read that again. I find these statistics throughout the week just fascinating, and I want to talk about them on the radio show because it's my job to bring this education to listeners. Allow us to help you. Maybe you have more knowledge to manage your own money, or maybe you can question an advisory group that you're currently working with. Really simple question. What are you doing? What are you adding? What do I have in my portfolio that can make money if the markets are down? If that answer is nothing, or if you can't get a good specific answer, or if you can't point to something in your portfolio, then we need to have a conversation, because those are the things that we are bringing to the table. That is how we help individuals compound their money and grow their assets, grow their net worth. That is how it's done. Miss as much of the down as you can. Make money even if the markets are down for some of your money. Ultimately, that's maybe your greatest hedge inside of your portfolio. The top 10% of stocks in the U.S. now reflect 75% of the entire stock market. What do I think of that? Well, it scares me a little, but it really doesn't matter what I think, because it can continue to go up, and it can continue to run, and it continue to defy gravity. Look at NVIDIA. I mean, NVIDIA just, well, it can't go up from 500. Well, it can't go up from 600. Well, it can't go up from 700. Well, it can't go up from 800. Well, yeah, it can. And it is, and it does. But the 10% stocks that reflect 75% of the entire stock market, this is by far the most concentrated stock market since the Great Depression in 1931. If you look at the dot-com bubble of 2001, which hopefully we can all remember, I remember being a young buck back then, getting in the business in 96, 97, and, talking with all of the Lucent Technology employees, and, just how all of their stock was in Lucent, their whole 401k made up, was all made up of Lucent stock. I couldn't talk them out of, diversifying. It just didn't matter. Okay. It just didn't matter. But the dot-com bubble in 2001, the concentration of the top 10% of stocks it peaked at 72%. So think about that. Today, the top 10% of stocks make up 75% of the market. Back in the dot-com crisis, it was only 72% of the market. I mean, even prior to if you look at the 2008 financial crisis, concentration of the top 10 stocks peaked at 66%. So on average, the top 10% of stocks reflect generally 64% of the entire stock market. So inevitably, people are going to ask, well, is a correction overdue? That's a great question. Nobody knows. Absolutely nobody knows. What I think, what your advisor thinks, what you think, it means nothing, because the market is going to do what the market is going to do. But here's what I do know. The Magnificent Seven, which are, just Google what the Magnificent Seven are, combined, it would produce the second largest stock market in the world. So, yeah, I mean, there are a handful of stocks that are dominating the market. And, is it different this time? I don't know. Nobody knows. I mean, if who knows? I mean, I think, those are the four most expensive words of investing is it is different this time, because no one knows. But here's what I do know. I know for a fact that you as an investor, you as an individual, if you're working with an advisor, I want to know what bucket of your money do you have in your portfolio that that you will not lose money if the markets go down, or you can even make money if the markets go down. And if you can't point to that, you just owe it to yourself to have a conversation. If you believe in the biggest banks. If you don't believe in the biggest banks, if you think an investment that you could make money when the markets are down is too good to be true, then don't bother reaching out. But those investments exist. And when it comes to the tax strategy, when we look at investing, okay, we look at diversification. Diversification isn't owning a bunch of mutual funds, individual stocks, or ETFs in the equity and fixed income space. That's not diversification. You may think it's diversified, but you own two asset classes. Bringing in a strategy that can give you double-digit distributions independent of the stock and bond market, that invest in the energy space, that can reduce your taxable income by $70,000 to $80,000 per $100,000 invested, that's diversification. Here's who calls us on those show. When we put out that message through just the radio and other just marketing efforts. Generally speaking, we talk to a lot of advisors managing and advising other people's money, because they want to know what that option is for their own personal money. I mean, that should tell you everything you need to know. Real estate's a great investment if you want passive income. Certainly better tax than treatment than active income, but you're still paying tax, right? What about the energy space? How about we reduce your taxable income by $60,000 to $70,000 to $80,000 per $100,000 invested? How about you invest alongside the biggest and best oil and gas companies at the asset level that is going to pay you distributions that are targeted to be between 13 and 18% a year? How about that? That's what we're talking about at our Naperville dinner in March, 13th and 14th. If you have an interest in that, give us a call. We'll see if it makes sense. 630-492-1912, 630-492-1912, because I'm concerned. I'm concerned with that everybody still has so much money in fixed income, and that they think that is going to protect them from ultimately losing money. We're 6 weeks into 2024, and the bond market is struggling again. Year to date, total return through February 16th of the Bloomberg aggregate bond index is negative 2.04. That data started in 1976. So we have 49 years worth of data. And only 1980, 2018, and 2022 had a worse start. So think about that. What is that? What advisor, are you still working with an advisor that is bringing you a quote unquote balanced strategy? So what balanced to you means equities and bonds, yet you've probably lost 20 to 30% over the last handful of years in the bond market. And 6 weeks into 2024, the bond market is struggling again. So we're down as of February 16th, 2.04%. Only 1980, 2018, and 2022 have had worse starts. So the year-to-date total return through, again, February 16th of the Bloomberg Global Aggregate Bond Index is negative 3.18. That data started being tracked in 1990. So there's 35 years worth of data. Only 2009 and 2022 had worse starts. So what are you doing? And that's what is so, I look at it and I say, if that was the only answer, then yes, you have to just simply invest in it and take it. There are big, huge brokerage firms, big, huge banks that advise on trillions of dollars, that their investors who have $100,000 to $3 to $5 to $7 million that are still using risk management strategies only in bonds. It's just not good enough. If that's you owe yourself to have a conversation with us, 630-492-1912. 630-492-1912. Yes, a lot is going on. More after the break.
Perhaps the most impactful piece of preparing for retirement is determining your current and future tax liability and developing strategies to minimize the amount of taxes you pay in retirement. Tax planning can have a large impact on your wealth and the kind of legacy you will be able to leave. At Kuhn Capital Partners, we provide you with a retirement strategy that can help you minimize taxes in retirement and take advantage of the 2024 tax rules. Visit KuhnCP.com or call our office at 630-492-1912 to get started today.
You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners. Yes, we are a registered investment advisory firm. Yes, we are a fiduciary. Our job is to make sure that individual investors, those that have $100,000 to $10 million, that's our sweet spot, that you can retire fearlessly. Think about that. You have to be able to retire fearlessly. The $100,000 to $1 million investor, they're laser focused on income. How are my assets going to generate income? The $1 to $5 million investor, they're not worried about income, but you know what? You should be, because you have the ability to use the asset size that you have to really go out and take less of your capital to create a very, very good income stream. The $5 to $10 million investor, you know what? A lot of times those investors just have it set it and forget it. It's on autopilot. They may be working with a bank trust company. They may be working with a family office. And that space has, what I have found, has the balanced strategy. The equity bucket is still using fixed income as a means of diversification. If you listen to the last segment, you know that the market, if we're looking at as of February 16th, if we're looking at the Bloomberg Aggregate Bond Index, it's down 2.4% this year. Data started since 1976. We've been tracking it, 49 years worth of data. Only in 1980, 2018, and 2022 had a worse start. And look at what happened in 2022. Don't lose money with your safe money. Those are the conversations that we're having, because we have to craft portfolios and can still make money when the markets are down. 630-492-1912. 630-492-1912. Set up a time for us to have a conversation. Paige will set that time. Our office is in Naperville. We do run this show in multiple markets. So if you are hearing my voice, hopefully that's a good thing. But we can work with you. So you can call Paige and set your time up to have a conversation as well. 630-492-1912. I'm very passionate about helping individual investors not lose money, and hopefully that comes across, in the market Hopefully that comes across, on the radio, whether you're listening to this driving around, this morning, or if you're catching it on the podcast. But we're very, very passionate about educating investors because too many investment advisors are lazy. I mean, it's really simple to figure out how much money they're making personally. All you do is manage generally 80 to 90% of the asset base that they work with, times that by 1.5%, and boom, there's their income. So life is good for most established advisors if you determine a quality of life based upon income. It's certainly a component, but that's not how I judge my quality of life. I judge my quality of life by how much time I could spend with my family, how much, of their sporting events that I can go to, how many times a week my wife and I can get away from the kids and just go and, talk to each other. I mean, goodness. So income is important, right? But quality of life to me is measured in many different ways. But I'm very passionate about helping individual investors not lose money. And that may come across to some people in a way that they're not comfortable with. And that is perfectly fine. I'm okay with that. I'm okay with coming across as somebody that puts down the advice business, because it's been my experience over 27 years that 9 out of 10 advisors are not providing any value to the clients that they're working with. Yet they are capturing a significant amount of personal income. And in many times, they're investing differently than the advice that they're giving out. And that is concerning. That is alarming. And when I see the statistics that I see of most people still using fixed income or bonds as a means of portfolio diversification, yet you look at the value destruction, the wealth destruction that the bond market has caused many individual investors over the last 3 to 4 years, it's just troubling. And so when we have access to strategies that are offered and underwritten by the biggest banks in the world, JP Morgan, Bank of America, Citigroup, all of them, that can help clients not lose money, that can help clients still get 6, 7, 8, 9, 10, 11% rates of return on a cash flow basis, as long as the markets are not down 30, 40, 50%, depending upon the investment that we went in. Other strategies that can remove 100% of the risk of the market and still capture what I consider to be a good potential investment, up to the first 11.5% of the S&P 500. That's why I get on this radio show. That's why I get on this, other, sources of media that I try to get my message out to, because I want investors who are fed up with paying an advisor to just simply track the market up and down. Those are the conversations that I like having on a weekly basis, that people just don't see value that is being brought to the table. Too many times do I hear, well, I have a concentrated stock position that, certainly here in Chicago, there's a lot of companies, a lot of people have $500,000 to $2 to $3 million of concentrated stock positions through their employee stock option plan that don't have a single hedge of that stock. And the advisor never even brought it to the table that, hey, you have a lot of your personal net worth tied up in this concentrated stock position. Let's talk about how we can hedge the downside of that market, of something happening to that stock. It may not mitigate all the downside, which in fact it won't, but it can eliminate potentially a lot of that volatility. Why aren't those advisors having those conversations with those clients? And it's just frustrating. It's frustrating that advisors continue to make $500,000, $1 million, $2 million a year personally, yet they don't. The way that they manage their personal money isn't the way that they're advising their current clients to manage their money. I was talking with a client who had an advisor in central Illinois, and they're down 15 to 20% in their bond holdings over the last couple of years. And he went and brought that issue up to the advisor, and the advisor said, well, that's where I put my money. And I'm thinking, really? Is that supposed to make you feel better that the advisor's losing money too? I mean, the problem is that it's so easy to sell a balanced portfolio, which is why everybody does it. because it's easy. You don't have to educate clients. Clients aren't learning about something new because it's human nature that when a client learns, an investor learns about something new, like when I tell them about the dual directional banknote. Okay, you get 20% on the up. You can make money as long as the market's not down more than 20%, and then you got a big buffer if the markets do go way down. Clients here, well, how can I make money if the markets are down 20%? So you're telling me if the market's down 20%, I can make positive 20% on that investment over 15 months. Yes, that is exactly what I'm telling you. Well, they inevitably think, well, it's too good to be true. It must be a scam. It can't be. It's, it's this, it's that. And you can't fall into that line of, thinking. Because if you believe in what these banks can do, if you believe in what these insurance companies can do, they can hedge risk in ways that you and I can't. And when you have a CUSIP, an investment that's created for you or a group of investors that is backed by a JP Morgan, and the investment parameters going in, how great is it to know if you could look at a bucket of your money and say, okay, over the next 15 months, I'm confident, and for some safe money, I'm comfortable with making a maximum gain of, say, 20%. I'm okay with that. 0 to 20%, I'll take it. So whatever the market does, I'll get 100% of that return up to 20%. That's fantastic. For that trade-off of the cap from 0 to negative 20, I actually get the inverse return. So if the S&P is down 1, I'm positive 1. So in theory, if we're going to be negative, let's be as close to 20% as I can, because if the indexes that we're tracking are down 20% and I have 20% protection, I make 20%, positive 20%. So people fall into this, well, it can't be. Well, it's too good to be true. Well, no. I mean, these are just very basic investments. They just don't mass advertise them. You're not going to see it with, a family walking on a beach. And, Wall Street, they're phenomenal. Do you think they pay, I don't know how many millions and millions and millions of dollars to test words and test, phrases and to test, scenes, because they want you to feel comfortable with losing money. Because if you feel comfortable with losing money, they're collecting their fees. And that's a problem. And I have a big problem with that, which is why we do the radio show, which is why we do the dinners. And you tell people about the dinners, for example, that we do when we looked at, tax planning, right? We're not tax professionals. I have to give you that qualifier. I can't give you tax advice, but these tax strategies are very basic. So talk with your tax attorney, talk with your tax accountant before you invest in anything. But there are strategies in the energy space that provide significant tax benefits to the tune of $70,000 to $80,000, $90,000 per $100,000 invested. And these tax strategies and these investments, rather, they have the big tax benefits. So if you believe in America, if you believe in energy, if you think we're going to need, oil and natural gas, you don't think that, the world's going to turn into, being powered by wind tomorrow or solar, albeit those are phenomenal strategies. I'm not saying that they're not. But look at oil demand globally. It's going up, right? Up. And if you can invest in a strategy, you probably have inside of your portfolio energy stocks. You didn't get a tax benefit on that. What if you can invest at the wellhead? What if you can invest directly alongside Exxon, Chevron, Devon, Occidental, the biggest and best operators in the world, right? Get a huge tax benefit and then get a piece of that revenue that comes off of those wells. And what if you had a portfolio of 50 to 100 in the best zip code in the world, West Texas, and the best operators, and you had significant tax benefits and you had targeted distributions of between 13 to 18% annually that was not dependent upon the stock market? Is that an investment that you would like to learn about? Well, if you're a high wage earner, if you sold a business, if you sold a building, if you make a bunch of money, if you sell a company, or if you just want to have something inside of your portfolio that can act independent of the stock and bond market, and you have $1 million net worth, exclusive, not including your house, then this strategy is available to you. And we want to have that conversation. 630-492-1912. I don't know of a single advisor in the Midwest or really at all that's going to provide that strategy that is in the best zip code in possibly the world, the Permian Basin, where 60% of domestic oil production comes from. So you're in the best zip code, right? The best basin with the best operators. And I tell people 13 to 18%, individuals love it. Somebody in the energy space say that's not good enough. Well, unfortunately, you're paying for that predictability. So the income or the distributions that are targeted are not as high as if you're wanting to take more risk. You certainly could go and get 3x, 5x, 10x that, but you potentially lose all your money as well. So big tax benefits, returns independent of the stock market. Those are strategies that we want to have conversations with you about. 630-492-1912, 630-492-1912. Our Growth Plus bucket. I promise you we'll talk about that after the break.
When you think of a puzzle, what would you say is the most important piece? A corner? A side piece? I would argue the most important piece of a puzzle is the picture on the box, and the same can be said for your retirement. Robert Kuhn from Kuhn Capital Partners would love to show you your retirement picture. For more information, call 630-492-1912 or visit his website at kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners, independent registered investment advisory firm, fiduciary, financial planning based. But what separates us is not that we're fiduciary, not that we are financial planning based. Anybody can run a financial plan. It's simple to do. One thing that we do is we keep that plan around, not just when we're trying to get you as a client and show you something flashy. Every quarterly review or semi-annual review, we actually benchmark our performance to the plan. That's key. When you're looking at financial planning, when you're looking at income planning, we want to benchmark this. We want to, we have a lot of clients that have, 300,000 to $1 million. They're worried about maximizing income. Well, let's talk about those strategies. We have other clients that are worth $10 to $20 million. They're not worried about maximizing their income. They're worried about, reducing their taxes that they're paying. So when we look at financial planning is fluid. It's fluid in the fact that when we have our reviews, we want to benchmark your plan to your performance to the review. What makes us unique is that we do that continuously. What also makes us unique is when we look at portfolio construction, we look at the fact that the markets can only go three ways, up, down, and sideways. That's it, right? Everybody driving around or listening to this on the podcast is going to make money in an up market unless you are just really trying to not make any money. It's almost impossible not to make money when the markets go up. But so many people think, well, I got a great strategy. I'm making money when the market's going up. Well, not necessarily. What did you do when the market went down in 2022? What did you do when the market went down in 18 for that period of time? What did you do or in 2018? What did you do in 2008? What did you do in 2000, 2001, and 2? Can you point to a bucket of your money that actually made money or didn't lose money when the market went down? Because it's not fixed income, generally speaking. So that's when we know if you have a good advisor. Look at in 2022, when equities were down, fixed income was down greatly. We went over all the fixed income statistics earlier today on the show, how this is the fourth worst year, or only three other times has the Barclays Aggregate Bond Index done worse than what's going on this year. And look at what happened in 2022. So you have a good advisor if you can point to a bucket of your money that is going to make money to a certain point if the markets are down. Or that, okay, I have this bucket of money that is principal protected, that cannot lose money. And for that trade-off, I get the first 11.5%. Currently, that's what it is, of the S&P 500 each year. So think about that. 5-year investment, can't lose money. So your worst year is 0. Each year, currently, you get 11.5% of the S&P 500. So the first 11.5%. And when you get a gain, that gain's locked in, never to go back down. So if the markets go down, you don't lose money. So when the markets then come back up, your gain is going on top of the previous gain. Why shouldn't you have some of that in your portfolio? Why shouldn't you at least have had a conversation about an investment like that that's available to you? Because that's the job of an advisor. I probably make it harder to bring on new clients because I educate more than most advisors, but I'm okay with that. 630-492-1912, 630-492-1912. Set a time up for Paige and I with Paige, for you and I to have a conversation. We do run this outside of the Chicago market. So if you are hearing this show, we can work with you. We are headquartered in Naperville, 59 and 88, literally right on the corner. So I can see Topgolf. I can see, CarMax. If you know where 5988 is, that's where we're at. So we're in the Citygate building, the Citygate restaurant building, or the Calamos investment building. But that's where we moved our office to be more centrally located from our Geneva office. Now, we do have other offices, of course, as part of the firm across the country, but this is where I sit. But again, we work with people. We have a very, very diverse client as far as geographical client base. It's pretty much all over. So I'm lucky enough to get to travel some, which is great, and see people in other parts of the country. So, okay, markets can go up, down, and sideways. When we look at portfolio construction, we want to bring it down to the basics. We want to bring it down to really 4 unique sleeves. Call them buckets, call them segments, call them whatever you want. But we want a protection sleeve. Those are the banknotes, and those are the other principal protection strategies. Again, those are the strategies that can actually make money when the markets are down. So we want our protection bucket. For some people, that protection bucket may be 80% of the portfolio. For others, it may be 10% of the portfolio. That's really based upon your individual situation, goals, and objectives, etc. We have our growth bucket. Again, our growth bucket is individual stock portfolios. I mean, we could spend all day on this. If you have over $100,000 and you own mutual funds or you own index funds, you have to ask yourself, why? Why? Why pay the fee to an advisor to own index funds and mutual funds? Again, you can outperform the market by picking baskets of stocks. It can be done. It absolutely can be done. Now, Wall Street doesn't want you to think you can do it. But again, Wall Street also wants you to think that it's okay to lose money and to pay an advisor a fee in a year like 2022, where equities and fixed income were down. So Wall Street has one vested interest: keep you invested no matter what, because they get their fees. Our growth bucket, I would love to talk to you about our growth models. We don't talk a lot about it on the radio. Very diversified, very trend following, that's what the market is today, folks. I mean, it just is what it is, right? You can over diversify a portfolio. I would venture to guess that 99% of people listening today are over diversified, meaning you're hurting your return. You don't need to own 1,000 stocks. You don't need, goodness, it's crazy. But again, it keeps the firms from getting sued, and it just is what it is. But we also have another bucket. It's called our Growth Plus bucket. That's where we really want to try to get returns. We're going to talk about that here in a minute. And then we have our alternative/tax bucket, which is our energy strategy, that if you have $1 million net worth, not including your residence, you have access to. Again, we work with people who have $100,000. We work with people who have net worths of 30 to 40 to 50 million. So to work with us, we don't have a minimum. Our requirement is, are you open to learning? Do you want strategies that you can put in your portfolio that make money when the markets are down? Do you want to include those strategies inside of a well-diversified portfolio? Do you believe the greatest way to beat the market is by losing less? If you do, then we'll work with you. That's fine with us. We love it. If you have 100,000 or 10 million, great. If you share those characteristics, that mindset, then we're going to be a great partner long term. But our tax strategy, as you know, in the energy space, the most overlooked area of financial planning is proactive tax strategies. If you're with a big bank or you're with a big brokerage firm, I promise you, you don't have access to these strategies. In fact, I have people that refer me their clients who are advisors at big banks and big brokerage firms. Can't tell you who they are because I don't know if they should be doing that or not, but they see it as such a value that they can't bring it to the table, that they refer their clients over to us just for the tax strategies. So I know for a fact, when you look at financial planning, you look at if you're working with a big brokerage firm or a big bank, the tax planning that you're receiving is so basic that you just owe it to yourself. You need more. So let's talk about our Growth Plus bucket. So what's the premise of that bucket? Well, that bucket's there to make money. to really outperform the market, to really try to reach for returns. And now that may be a 5% allocation of your portfolio. For some people, it may be 30 to 40% allocation. But when we look at a well-diversified portfolio, it needs to have 4 characteristics: protection, growth, growth plus, tax, and alternative. The growth plus bucket that we use, we have access to a manager that through working with us, the minimums are very attainable for everybody. This particular strategy, if you go to them direct, you need to have $500,000 in just this strategy. So you probably have a $3 to $7 million portfolio. But we have access to just this strategy for $25,000. It's mathematical, computer based. I'd venture to guess that they have more computer programmers on staff than they do money managers. And it's very trend following. And trend following means they don't care what's happening in the market. They're following the computers. And if you want to have some money that is non-emotional, that has a repeatable process, that is following what the computers are doing, that 95 to 90, I've seen studies that 90 to 95% of the trading on the exchanges today are all computer driven. You can't wear out a stock or an ETF or a bond. You can't. And mathematically, when you can look at it, again, programmers, you look at some of the big hedge funds, they may have 30 to 40 programmers on staff, computer guys, trying to find algorithms that can beat the market. And guess what? They are out there. So what makes us unique, what we're bringing to the table that others are not, are strategies that can do well whether the markets are up, they're down, or the markets go sideways. We want protection. We want strategies that if the markets are down, if you believe in the biggest banks and their strategies that are backing them, that you can have positive returns to a certain point in negative markets, let's talk. If you have growth, you're not your own index funds or mutual funds, we absolutely need to talk. If you have nothing inside your portfolio that you could point to that is really there to get after it, to really get after the returns, that's mathematical, computer based, that can, just historically, again, you look at the returns and you decide if they're good enough for you for some of your money. Well, let's have a conversation. If you're a high wage earner, you sold a business, sold a building, have a bunch of real estate that you're liquidating, you sell a company, or you just make a bunch of money and you want to reduce your taxable income, let's talk, because we can talk about an energy strategy that can reduce your taxable income in the neighborhood of $70,000 to $85,000 per $100,000 invested. And that's active, that's passive, that's capital gains, it's above the line there. So it's greatly reducing your taxable income that has targeted distributions between 13 and 18%. You know what? That may make some sense to have a 3 to 5 to 10 to 15% allocation of a portfolio. So here's what I want to leave you with. I don't really know. Nobody knows what way the market's going. I could see a case for it to continue to defy gravity, and I could see a case for it to drop out of the sky. The reality is I don't care, because I'm going to craft portfolios for clients that we can deliver what they expect no matter what is going on in the market. Whether you have $100,000 or $10 to $15 million, that's a value proposition that if you're not getting today, we would just welcome the conversation and have that talk with you about what it is that we're doing, allow us to educate you on the strategies that we utilize. And if we can end up partnering together, then fantastic. If not, and you walk away a little bit more educated than you were before we met, then I did my job. So with that being said, I hope everybody had a great week. I hope everybody finds value in the radio show. We'd love to have a conversation with you. 630-492-1912, 630-492-1912. Set that call up and make it a great week, and we'll have some more topics to touch on next week. Take care.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.